Earlier this week, the market had just experienced one of its worst days since 2022 so far, with the S&P 500 falling by more than 5% over the past 5 days. Nasdaq was down by 10% at one point, and needless to say, some stocks like Tesla got totally massacred, having crashed by 20% before recovering slightly.
I'm okay, I'm fine. Kinchana.
So, in this video, I'll be going through why did the stock market crash so hard until its mother also cannot recognize? Is the crash over yet? Or will it crash some more? And more importantly, how should you be investing in this kind of market? Also, before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. Alright, the first reason why this crash happened was due to the jobs data which came out last Friday. It showed that 1. The US economy added a lot less jobs in July than expected, and 2. The US unemployment rate suddenly jumped up to 4.3%. Now, by itself, these two data doesn't signify anything bad. However, the real reason for the market crash is due to something called the Sum Rule Recession Indicator, which says that if the 3-month moving average of the national unemployment rate rises by 0.5% above the low from any point in the previous 12 months, a recession will happen. And so far, it has been proven to be pretty accurate, which means that we could be seeing a recession coming pretty soon. However, according to the inventor of this rule, Claudia Sum, she says that while this rule has been triggered, it doesn't really mean much because the Fed could still cut rates to take some pressure off the economy, and we also shouldn't rely on just one single indicator. So what other indicators could we look at? 1. The US economy still remains pretty strong. In fact, just last month, the US economy grew way more than expected. 2. Among the companies that have reported earnings for the latest quarter, 78% of the companies have beaten their estimates, which is above both the 5-year and 10-year average. And at the same time, analysts are also optimistic that companies will continue to increase their earnings per share over the next few quarters. And third, while the yield curve inversion has indeed happened for quite a while back, the truth is that historically, it could easily take anywhere from 10 months all the way to 47 months before we see a recession, which is like God say, like no say, because literally anything could happen during that period. So just because the Sum Rule got triggered, there's nothing much to be worried about yet. But of course, you may ask, what if a recession did happen? How hard will the market crash then? Because everyone says the recession is bad for the market, right? Check this out. If we look at the blue bars and the purple bars, which represent the S&P 500 6 months and 12 months return after each some recession trigger, what you will see that is that in most cases, the S&P 500 has given some incredibly positive returns during that period. For example, in 1957, 12 months after the trigger, the market saw almost 40% gains. 1980, between 20 to 30+% gains, and in 2020, again 30+% gains. The only times we didn't see positive gains were during 1959, 2001 and 2008, which have given negative returns, which, to put it simply, makes this a pretty unreliable indicator to rely on if you want to use it to time the market. Likewise, the market has also performed surprisingly well when it comes to recessions. For example, during the recession period, the market saw an average return of -1%, and crashes are actually very rare. And 6 months prior to a recession, there's a -2% average return. 6 months after a recession starts, 7% average return, while having positive periods 82% of the time. So again, even if a recession may come, let it come. There's nothing much to be worried about. Now, besides recession fears, a bigger reason as to why the market crashed earlier this week was due to something called the yen carry trade. So what happened was that since 2007, Japan had super duper low interest rates. This enabled investors to borrow yen at very low rates, like at 0.4%, then convert their yen to US dollars to invest in stuff such as the US market or the US Treasury bonds. Essentially, it's like getting an almost interest-free loan. However, as of last week, the Bank of Japan suddenly decided to raise their interest rate by 0.25%. While this 0.25% is sibei tiny, its effects are huge. That's because this caused the Japanese yen to strengthen against the dollar, which also means that those traders who are holding the US dollars are now forced to take a huge loss when they want to convert back to Japanese yen. At the same time, since the interest rate has gone up to 0.25%, traders are now forced to pay extra interest for every day that they are holding the trade. When you combine these two effects together, many traders are now forced to unwind their positions to cut their losses, which causes the market to start falling, which in turn trigger margin calls for other carry traders as well. This of course caused the market to further go down, though interestingly enough, as of Monday night, the market has started to recover back. So is the carry trade saga over already? Well, not really, because even though Japan's interest rates has been raised, this 0.25% is still very attractive, especially when you can just borrow this money and invest in US Treasury bonds to earn around 5% yield. So for now, this saga would still continue on for a while longer. And given that the Bank of Japan intends to raise the rate again later this year, we could be in for some bumpy rides ahead. However, there's nothing much to be worried about since this will only affect short-term movements and not the company fundamentals. The next reason as to why the market has been so bumpy is due to the conflicts in the Middle East. Then you'll be like, wow, war leh, like very scary stuff However, while wars are overall bad for humanity, it has barely affected the market since almost 100 years ago. In fact, whenever there's major market shock events, the market has on average recovered within 47 days, with only an average drawdown of negative 5%. Basically, the market be like, whoa, meh. So those were some of the main reasons as to why the market crashed. As you can see, there's nothing much to be worried about. But here's the thing, while I can just say, so market up, you buy, market down, you cry a bit, then you buy more, I can definitely understand that all these big drawdowns can be scary, especially if you are a new investor who has just started investing within these few years. Plus, it has been quite a while since we have seen fear in the market. Like the last time weeks the fear index was this high was during the 2020 pandemic crash, and even then, the recovery has been rather fast, so most people won't even have any time to feel scared before the market has recovered. So here are a few tips on how to stay calm in a scary market. First, if we just zoom out a little, you can see that this crash is rather small. In fact, we are still up by 10% year to date. And what's surprising is that other than this crash, 2024 has been a rather calm year as compared to the previous years, where the market has been a lot more volatile. So it's important to understand that this kind of drawdowns are extremely common, where historically there has been a 94% chance that we will see a drawdown of at least 5% or more. And around 2/3 of the time, we will see a drawdown of at least 10% or more. So this is a perfectly normal situation. In fact, this kind of drawdowns are good, as they will give us more chances to buy the dip. But then you might ask, yes, but wouldn't it be better if we can sell now and avoid the dip altogether? While that sounds good in theory, just know that it is literally impossible to predict where the market will go in the short term. For example, even though Warren Buffett's first rule of investing is to never lose money, we can see that his portfolio constantly experienced drawdowns, especially in 2000 and 2008, where his portfolio dropped by more than 45%. But despite these drawdowns, he has still managed to outperform the S&P 500 by almost double. So rather than trying to time the market, it is way more important to make sure you are always investing in good stocks like Microsoft or Google and so on, where you know that they are fundamentally very strong and you won't panic sell whenever a crash happens. But if you don't know how to look for good stocks, an easy way is to just stick to broad-based market ETFs like the S&P 500 ETF, SPYL, Growth ETF, SCHG, or All World ETF, VWRA, where you are always guaranteed to invest in the best companies in the country or the world. And just in case you are wondering where you can buy these ETFs, they are all available on IBKR, which has the cheapest trading fee. Sign up link down below, yeah. And despite whatever nonsense the market throws at them, given enough time, they are able to recover over the long term, which by the way is also known as positive drift. So as long as you have good holdings and you don't panic sell whenever a crash happens, you'll be fine. The only people who will panic sell are those who either don't know what the heck they are buying, or those who are investing with money that they either don't have aka margin, or money that they need soon, aka short-term savings. So always know what you are buying and only invest with the money that you don't need within the next 10 years, because the longer your investment horizon, the less likely you will see a negative return, provided you invest in a good stock, of course. And lastly, avoid timing the market altogether, because no matter how good you think you are at timing the market, the reality is most people suck at timing the market. And just by missing some of the best days of the market, your returns will either drop by more than half, or you will start seeing negative returns, which is like, might as well don't invest already. So as always, consistently dollar cost average no matter what. Market up, you buy. Market down, you cry a bit, then you buy more. And over the long term, you'll be fine. Anyway, that's all for this video. Hopefully you found this useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.